Hi, I'm Ted Finch, the president and founder of Channelmill Marketing and Channelmill.com, the ultimate resource for software marketing. Within the next few minutes, you'll hear more about how to finance a high-tech startup. You'll hear from some of the nation's top VCs. You'll also hear from several local and regional boutique VCs. Not only will you hear from the partners, but you'll also hear from some of the screeners, those people that actually take your business plan and review it prior to passing it on to the partners. In addition, you'll hear from several CEOs who have been highly successful in financing their own company. And finally, you'll learn of alternative methods to finance your company, including the 504B, which is a backdoor approach to going public. I hope you enjoy what you see. Let's go ahead and hear from the experts.
There are multiple stages in the creation of a company. The first stage is always considered to be the seed stage, and the seed stage is usually funded by friends and family or angels, and it's usually anywhere from a couple of $1,000s all the way to maybe $500,000 or so.
The second financing round, which may be your first Series A preferred round, is usually a round that can be $2 to $5 million. Again, it can be milestone based, and that's where you're really looking to develop the product, to establish some beta customers, and in many cases you want the product finished and at beta, being tested and having a customer willing to buy either that enterprise software product or that device and evaluate that product. The next round is usually the Series B preferred round, and that is a round really that ties to ramping the company to profitability, to break even, adding more people, and developing the markets, further developing the markets. After that, there's the C and D rounds, can be called sometimes mezzanine rounds, and then in the past, after that has been an IPO or an acquisition.
You may find some venture capital groups, in fact, in the late 90s, early 2000, you would see venture capital groups actually providing seed stage funding. They've gone away from that, so it's much more difficult for entrepreneurs and startup companies to find that seed capital. Next stage would be a mezzanine level of funding, where you really would go to a venture capital group or an alternative financing organization who now knows that the company has had at least enough to launch the company to a degree that they may be close to commercialization. What we're finding is most venture capital companies today are really looking beyond the mezzanine level, where they normally had participated in years previous, to the next stage, which is really beyond initial commercialization to a stage where the company really has a product in the market, has high enough revenue streams where venture capitalists can now participate either in growing the company, going to a quick IPO, or doing some sort of a roll-up.
Elements in the business plan that we want to stand out is, first of all, an understanding that you understand the product you are developing, you understand the market, who your potential customers will be, and an understanding of what it's going to take financially to ramp the company.
Every person looking at documents from the point of view of an investment proposal has slightly different views on what they expect. And the optimum scenario is you prepare a detailed plan for every single person tailored to what they're looking for, and that is really the best way. However, there are practical considerations. You can't spend 20 hours a day your entire life writing business plans and modifications thereof. So most people try to hit the broadest group of people that they're targeting with one plan that's well written, concise, and a cogent explanation of the industry they're in.
One of the things that business plans are typically missing are just clarity and focus, a lack of balance between depth and brevity, and by that I mean some plans are 1 page long and that doesn't really help us. Other plans I've seen are 40 PowerPoint slides and that doesn't help us either, so something in the middle. A lot of plans are missing detailed financial statements. And finally, a big gap that I often see in plans is a lack of thought about channels and specifically how to get the business plan's product or service to the end user who's actually going to have to open up his or her wallet to pay for it.
The biggest hole in most startup business plans is in the sales and marketing strategy. The CEO generally can talk for hours about the product or the service and can give the backgrounds on the management team. But when it comes to a sales strategy, they usually try to just say, there's a tremendous market, there's a $10 billion market, and if we just get 1/10%, we'll be successful. What the VC is looking for is how and when will this CEO be able to sell the first product to the first customer, and then how and where will the next 10 customers come, and to see the rollout from 1 customer to 10 customers to 100 customers to thousands of customers. Usually that detail is left out in business plans.
The first thing that absolutely categorically, without a doubt, has to be there is, how are you going to make money?
A couple of plans that stick out in my mind had table of contents and outlines at the beginning to help guide me through the document. Were probably no more than 10 to 15 pages long total. Included really nice detailed financials at the end. Had either an illustration of the product or diagrams or some website references so that I could get a visual of what they were talking about.
You really want to see the entrepreneurs, you really want to see the PowerPoint presentation they have, you want to hear them describe the business. That's how I like to evaluate a company. Business plan, really secondary. You know, people invest typically far too much in the business plan. I'd rather hear the presentation, hear what kind of validation work's been done, and then if it's a go-ahead, take a look at the business plan and the other paraphernalia that comes with the company.
The 3 things that a venture capitalist would look for in a company always has been, number 1, the management team. A team that has some experience and has the drive to make the company a success. Then it has to have some kind of a product or service that is it can be a great product in a market that is booming. So there's a tremendous upward potential. And it has to be in a market that can beat the competition and do it quickly.
I think all VCs look at the management team, the product, the market, and the financials.
I think investors will primarily want to validate the pain. Are you solving a real problem with your solution? Is there a market for it? And then, is the market big enough?
If the people are good, the size of the market is big, and it's an industry that's growing and dynamic, you increase the odds of success.
Okay, the venture capital companies today look at the startups very differently than they did 2 or 3 years ago. Now when they fund a company and they call it an early stage company, it's similar to what a company might have been a few years ago called looking for Series A funding. Today an early stage company needs to have revenue. Probably it's been in business for 1.5 to 3 years, has 2 or 3 paying customers, and has a product that is past version 1, has been tried, been paid for, and now we're looking at really the investment money is to be used to expand the marketplace, where you have an existing model, existing product, existing customers, and you want to take the company from a $1 million to a $50 million company in the next 5 years.
In real estate, the 3 most important things are location, location, location. In investing in venture capital situations, the 3 most important things are management, management, management. The rest of it pales in comparison.
Top 3 things you look for as an investor are experienced management team, experienced management team, and experienced management team.
We place the most weight in our decisions on the management team side in probably the managers or the co-founders' recognition that they may need complementary skills to build their company. Their willingness to accept those skills, their willingness to talk to outside independent advisors, their willingness to share equity with key advisors and key employees.
In terms of management teams, the criteria is pretty simple. Good people make good things happen. And if people are highly qualified, highly motivated, and understand exactly what they're getting into, then the venture should be successful, everything else being the same.
Characteristics of a good management team. Well, I like to talk about execution intelligence, which means the collective ability of the team, emphasis on the team, not the individuals, to perform as a group. You'd like to see people who've been down the learning curve in engineering, in marketing, in operations, in manufacturing, again, depending on the type of business it is, but people who've essentially learned on somebody else's nickel. Then you want to see a team that's very cohesive and knows how to work together. And then you want to see a strong leader, but you don't want to see a strong leader who's so ego-driven that they cannot take input from the market and cannot listen to the rest of their management team.
When investors look at a management team, they look at really several factors. They really look for an experienced team, a team that you can say has been there and done that, meaning taken a startup company or an idea from startup and taken through the growth stages and then through a liquidation stage. They're looking for a team that can manage other people as they grow and a team that understands the entire funding process.
The management team that is running the company in any stage, regardless of the fact that the management team may evolve in time in the different stages, is two things. First, there's got to be chemistry. The people must be able to get along and work together, respect each other, be passionate about working with each other, being, and delivering on the promise of the vision. And two, it's very paramount, especially now more than ever, to have experience either on having done it before in that particular segment of the market or in having been in the similar stages, if you will, of the size of a company.
Two elements that we use to identify a quality management team. Number one, their experience. Clearly, it comes down to their experience and ability to execute. Most folks have terrific ideas. As we said earlier, ideas are a commodity, execution is king. So we look for folks who have a true track record of success relative to execution.
Well, most startups ignore market issues in their early life. Typical startup is a lot of engineers with a lot of technical expertise. But it's interesting, startups never fail for technical reasons. They might be delayed for technical reasons, but they seldom fail for technical reasons. They do fail for market reasons, meaning wrong product, wrong market, wrong customer, wrong channel, any number of things that can go awry in the process of developing the product. So my recommendation is get your market right, validate your market, bring on market resources early. Don't start building anything till you know precisely what you're going to build. Then bring on your technical team.
When it comes to product, the investors are looking for really something very special, something that maybe is not out there today, or something that is better than what's out there today in a marketplace that is a niche market that they could really end up owning.
First release products should contain the minimally acceptable feature set for the target audience. The reason why is for every day you're out building your product and not actively selling or marketing it, the market is changing underneath you. So you've got to get to market very, very quickly with a minimally acceptable feature set. The best example I like to use here is Microsoft. Nobody I know uses Release 1 or Release 2 of any Microsoft product. They do use Release 3. Why? Microsoft ships minimally functional products for its first release, improves them a little on the second release, and by the time they get to the third release, they've usually got a good product. And remember, Microsoft has more money than anybody else on the face of the planet. They can afford to put literally thousands of engineers against the problem and brute force create a market, but they never do. They take small teams of 10 and they slowly and methodically tackle minimally acceptable products delivered to the market and then refine based on market input.
What happens in entrepreneurial companies is the last hire they make is the marketing guy. Quite frankly, it's one of the first hires they need to make because it's important that they continue to hone their message, their positioning, how to take their product into the market, determining their channels of distribution, what are those messages and what are those channels that they can leverage to have to quickly executing and get traction in the marketplace.
Market validation is a technique I've seen work to great success inside many investments I've made. And when I say market validation, what I mean is going out and really getting to know the market personally. And when I say personally, I mean the entire management team. And this involves everything from customer interviews to analyst interviews to any number of techniques from focus groups to market research to secondary research. And actually a great deal of a good hard kick in the ass focuses on this and always talks about getting back to the market and how the market is the thing that ultimately differentiates whether a company is going to be successful or not. And it's a company's job to understand what the market wants, because if you really do understand that, your chances of success go up dramatically. But too often people get more obsessed on the product or the delivery of the product or the operations issues or the simple checklist items. You know, did I save 10% off the copier and did I get a good deal on real estate? In the end, I'm not saying those aren't important, but they have nothing to do with the success of the company. What does determine the success of the company is how well the market is known, how well it's understood, and how intellectually honest the team is about incorporating that market input into their product.
There are multiple sources to find venture capitalists. Obviously, the number one resource would be the internet. You know, there are different publications online. There is VentureWire. There is the National Association of Venture Capitalists. There are, you know, multiple organizations, and then there are the venture capitals themselves.
We develop our business by having a CEO of one of the companies that we have funded and supported hear that someone is looking to start a company and refers that person to Access Venture Partners. That is important, but we do take a look at what we call over the transom deals, cold deals.
And at the end of the day, it turns out it's always usually somebody you know.
I think the most important thing to focus on is, in fact, the domain or the segment or the industry that you're targeting, and really do a lot of homework about the market. And when you start doing the homework about the market, the size of the audience, who you're going after, what companies you're going after, you very quickly will find, you know, either press releases or information associated with that industry segment in particular that you're going after. And then you'll see the whole kind of ecosystem. There are investors around that, there are companies that buy products, and then there are companies that make products for that particular industry.
The types of entrepreneurs that have success raising capital typically know their investors in one way or another, be those investors angel investors, institutional venture capitalists, or simply customers from which they get a consulting contract to get into the business. And the reason is people like to do business with people they know, and the customer or the investor will probably find somebody who knows a space and has learned a space in a previous life. And they're much more comfortable either having that person do a consulting contract or making an investment in that person's company based on the fact that they have experience in the category.
Initial screening process, an entrepreneur may call or we receive an email saying, are you interested in a given company? We take a look at the executive summary. We always request an executive summary. And we read the executive summary and call the folks back and say we are interested and schedule a meeting, or we're not interested, and either recommend they go to suggest another fund or just suggest that maybe they come back to us when they're in a better position from their business plan standpoint.
It's fairly unusual for a plan to come in off the streets or over the transom and get funded. Usually there's some connection into that fund. Either the entrepreneur has worked for a portfolio company inside the venture fund, or again, there's a service provider or other connection into the venture fund. And it's important for entrepreneurs to find a way to get inside instead of simply submitting a business plan, because there are so many that come in and week out. It's really impossible to separate the good from the bad without having some kind of personal connection into it.
We see business plans per year at numbers in the hundreds. We have an associate who is typically a graduate student, and his main job is to be the first set of eyes on all the plans. And then what he'll do is he'll be looking initially for things that fit our particular screening criteria, which in our case is geography, the stage of funding, early stage in particular, and the industry, the sector focus. Once it clears all that, and if it's something that he thinks would be of interest to the partners, then I get involved and make an intermediate decision about that. I try to anticipate the kind of questions the partners would ask in the investment committee meeting and help gather the due diligence to answer those questions. And then help the associate make a presentation about the particular company or business plan to the investment committee meeting.
There's sort of some key points that usually results in rejection of a business plan or an idea is that we don't feel the entrepreneur really understands the product and the market. We can sit down with a company and spend a half an hour in this room and not know any more about what their product is or was than we did before the meeting started.
The selection of your investors is paramount. It actually makes or breaks the idea.
The startup CEO should also investigate the venture capitalist before you make the call on the VC. You should look at the type of companies or products they are funding, what they like, what they don't like. You don't want to get into a competitive situation with them. You might even ask other people what they know about the VC partner that you're going to meet, so that when you make that initial sales call or you make that presentation, you really know what they're looking for so you can close the deal.
Questions entrepreneurs seeking funding should ask their investors are, what value are they going to add on top of the money they're bringing to the table? It's fairly common to hear the comment that everybody's money is green, and that's true. And although as an entrepreneur frequently you're dying for somebody to give you money such that you'd take anyone's, don't. You've got to find somebody whose money comes with good advice, good experience, good contact network, and good mentoring abilities, because you are going to get very, very close with these people, and you want to make sure you're taking it from somebody who can add value to your company.
Another question you'd want to ask is what can they do, or how willing are they to help you in terms of seeking additional financing and or helping you penetrate accounts, potential accounts to market to within your industry segment?
And some venture capitalists are focused on particular segments of markets or industries or geographies. And so you want to really do due diligence on finding not only an investor that is interested in what you're doing, but also an investor that perhaps has not invested in something that is one of your competitors.
Definitely you cannot group all venture capitalists into one bucket and make generalizations about them. For example, I think most venture capitalists are thought of as vulture capitalists from the perspective of the entrepreneur. That may be true for those general partners who have got into it without any operating background, without any true entrepreneurial startup background. Perhaps they come more from a financing background, are interested in great returns for their limited partners. But that's definitely not true of all venture capitalists. Our firm in particular prides itself on the fact that one of our general partners has been CEO and chairman of a public company. Another one of our special limited partners has been the senior executive at several well-known startups. We're really more interested in working with great people who have really cool ideas, who want to attack very large markets, who we think we could really help build a great company out of. That's why we in this firm are doing what we do every day.
We're really focused on the companies. We add value, I think, at all levels. We get personally and directly involved to the extent you want us involved. We spend time with the board, on the board, with you before the board meetings. We work with the other VCs that are involved with the company. We, again, go through the whole help with the recruiting process, and with the team building process, with the market building process. Again, because of our relationships in really 2 states and then the Bay Area, we know a lot of folks who may tie into your company from a product and a marketing standpoint, and that's the value we add.
A lot of entrepreneurs make a lot of mistakes thinking they must have one VC firm or another based on geography, prestige, size of their portfolio, portfolio companies, reputation, etc., etc. At the end of the day, get your money. There's no other rule that works. So if you have the opportunity to finance with the very, very best Tier 1 VC firms, great. Make sure you get your money in that process so that by the time you end up finishing your tour of the VCs and the Tier 1s in particular, you haven't run out of time, and therefore you're bankrupt of any future possibility of continuing the fundraising activity.
The biggest mistake that entrepreneurs make is they get a shot. They get a shot at pitching for money. There's, a typical venture capitalist will probably see, 1,000 deals a year, most, on paper. But he will only have time to really talk to 100 of those 1,000 deals. So the fact that you're being invited to a meeting, you've already made a phenomenal cut.
The investment presentation is crucial to raising money. You have to understand that venture capitalists might see 100 presentations in a month, and their eyes can get really dreary looking after a while. So the presentation has to be short, and it has to be succinct, and it has to be exciting to them. The presenter should use any type of multimedia that they can to get the excitement up. They have to understand what they're presenting and understand what the investors want to see or want to hear. And at the end of the presentation, they should be able to ask for the order.
You have to have these 6 questions answered, right? The pain, your solution to that pain, the size of that market, the management team, the competitive advantages, and then the business model and the financials.
Key points of what's the content of a first meeting with a venture capitalist. First of all, that meeting usually takes an hour to an hour and a half. We want to get a clear understanding of what your product is, what market you're addressing, what problems you solve, challenges you have in putting together and ramping the business, and a good initial financial review of your burn for the first 12 to 18 to 24 months of the company.
You have to be very open-minded, to be not defensive, but to actually be vulnerable, if you will, and put yourself out there to answer the questions they have. And sometimes the best answer is to actually say, I don't know.
A bad presentation from the investment committee is one where the entrepreneur doesn't answer the question. If he or she doesn't know the answer to the question, then a perfectly acceptable answer is, I don't know. But we from the VC side don't hear that often enough. Another characteristic of a bad presentation is one that's all one way. If it's just the entrepreneur talking to us in a complete diarrhea of the mouth for 20 minutes and there's no two-way, there's no dialogue, that's not a very useful meeting.
First clear meeting, the purpose of that meeting is to get a second meeting. Your philosophy coming into a VC should be, how do I get my second meeting?
A good presentation is one that's more of a give and take, really more of a two-way dialogue. A good presentation answers the VC's questions. If it doesn't answer the questions, it maybe helps us think about the question, rewording the question, or a good answer if you don't know is, I don't know, let me get back to whatever resource and I'll get back to you in 24 hours with that answer.
During the presentation, a typical presentation might last 20 to 30 minutes in the presenting part. And the presenter, usually the CEO of the startup company, should be prepared to stay another half hour to an hour with the venture capitalist, answering very difficult questions.
A good presentation is flexible, and by that I mean if you've brought in 50 slides, 15 of them are about product development, and it's clear that we're not interested in product development, you can just skip those 15 slides and move on to the 3 that you do have about your management team or something that we appear to be interested in.
If an entrepreneur starts a meeting by asking us to sign an NDA, we just don't take the meeting. We see far too many deals. It's far too hard to separate whose idea was what. And by the way, if the NDA is the only thing protecting the idea in the marketplace, it's probably not going to be a good venture investment. That's not to say it wouldn't be a good business, but it's probably not a differentiable or defendable enough business for a venture capital firm to invest in.
Most VCs do not sign non-disclosures. And one of the key reasons is that this is our reputation. I don't know if I've ever read where a VC has, quote, stolen an idea. It's our reputation. If it was ever in Austin or in Denver, where we do most of our deal flow, if we ever violated a trust, it would be the end of our fund.
The only main reasons that I would say you would say no to money would be the terms of the money and the source of the money. It could be that you change your mind perhaps through your due diligence, or you discover something about that venture capitalist in particular or the firm that he represents, or it could be the fact that the negotiations and the terms have evolved into something that it's something really that you cannot live with.
In essence, the terms that a VC is looking for is to A, protect their investment, and B, they're trying to make as much money as humanly possible in the shortest time frame possible. So if you need the money and it's the right amount of money and you're pretty confident you're going to get what you need to have happen, then the terms are usually not an issue. But things I would look for are anything to do with what are called toxic securities, which means ratchet clauses, doubling down clauses, anti-dilution protection, so that if you run out of money and you have to finance again, the person who put up the money originally gets protected, so all of the dilution falls on the management's head. This is something that's become very common in the last couple of years since the recession and since the meltdown in the venture capital community. So that is something that's very, very difficult to take a couple of years later, especially if you're just at the point of reaching commercial success and you have given some toxic security provisions out previously, and they come back and bite the financial situation pretty hard. Other than that, board representation and all the other things, they're pretty standard. Hire yourself a good lawyer and you shouldn't have any problems.
I cannot emphasize how important it is to spend an incredible amount of time on making sure that you have the right valuation.
Well, valuation is maybe one of the more difficult terms in venture capital. It ties to what we feel the value of the company is, and the management team feels the value of the company is. Usually a two-way street. We want agreement on valuation among the investors and the management team. It can range. There's sometimes comparables where you can look at comparable companies and in their development what their valuations were. Sometimes it's more of if it's a very, very early company, it's more of just being fair all the way around to the investors and the founders.
One of the things you have to be careful of is to ensure that the time period to even consider the investment in your company gives you enough time to consider multiple opportunities.
The biggest thing you need to be aware of when you receive money from a venture capitalist or an angel really has to do with what's called the preferred shares they're buying and the terms and conditions of those shares. So the biggest thing to look for is liquidation clauses. So anybody who tells you that they need to have more than one time the investment that they put in as a liquidation clause, it's really taking what it's called a pound of flesh. Some venture capitalists are as onerous of asking things like 3 times, 6 times, 10 times return of investment, which means that if they invested $1 in your company and your company is worth 5 or maybe 7, and at some point it gets purchased by 10, but if they had a clause that says they get 10 times their money when any event happens, then they get the entire $10 and you get nothing, and you just work for them. And that would be, sort of capitalism to the far right.
If you deal with an awful lot of traditional venture capitalists, they will dilute you down to, say, 70% of the business. They will also have a requirement that the next 20 to 25 or next 20% of the business is set aside for management and for a stock option pool, thus leaving the founders with about 5% of the business. So dilution's a major issue.
Pretty standard, especially in first round deals. There's a valuation, there's the amount of money that the venture capitalists will invest. There are sometimes milestones in term sheets where we specify that we will invest X dollars when certain milestones are achieved by the management team. There are just some basic setup of preferred stock. We usually work with preferred stock and gives us a preferred position. There's board seat confirmation. Sometimes there's observation rights to the board. But it is, again, pretty standard from one deal to the next when you're talking about first round investment.
The other thing would be, in particular, any kind of termination clause that has to do with the founders, their shares, or the management team. Anything that would could potentially harm upon receipt of the money to take and shift the dramatic structure of the team or the founding team or the key members of the team.
My best counsel is to get good counsel. It makes the process, I think, go much smoother.
Time frame once you pass all the criteria is really difficult to estimate. It really depends on whether you pass with or without due diligence. It's not unusual for a term sheet to be issued subject to due diligence. But the process usually takes, 3, 4, maybe 5 months. Frequently, I've seen it's the entrepreneurs sort of negotiating that usually slows it down. Most venture firms have a standard form of agreement they're going to use, and it's probably best not to let the entrepreneur or the attorney for the entrepreneur get too wrapped up in the details, because in the end, the person who has the money is probably going to set the terms. So my advice is agree to the business terms up front, and then if you agree to the business terms on the front end, negotiating the details and figuring out how to turn that into legal paperwork is fairly straightforward.
Typical time frame required to acquire funding in a company is dependent, again, on the level of funding and where you are in the maturation of your company. As a seed stage company, you may find that you're able to acquire funding within 60 to 90 days through a network of angel investors, and potentially through other means, venture capitalists, etc. Typically, though, acquisition of funding requires between 6 months and a year. Most venture capital firms will begin talking, require evidence, go through your business plan, a series of meetings, and a very quick turnaround through a venture capital group would be 6 to 9 months.
Classical mistakes are made around the notion that build it and they will come. So entrepreneurs or management hired by entrepreneurs might fall into the tendency of spending exorbitant amounts of money to quickly go to market, to perhaps invest in infrastructure, to get big offices or a huge warehouse, to start really sinking cash, good cash, into hard assets that don't generate sales.
Some of the biggest mistakes entrepreneurs make when they come for venture funding is really not understanding what a venture fund is all about. You know, the role of a venture fund is to make a return for its limited partners, and these limited partners are pension funds, retirement funds, school endowments, and many of the entrepreneurs actually have money indirectly in these venture funds because of those relationships. So understand, if you do deal with a venture capitalist, that their job is to get a return, and they're going to manage a company in a way that produces a return. And frequently, entrepreneurs don't understand this, but it's important to understand before you take venture capital.
I think really there's three areas somewhat tied together. The first area is a reluctance to talk to advisors, independent people who have some subject matter expertise in the products or the markets you're looking at, and will give you some very objective advice. Secondly is a reluctance to surround yourself with very smart people, complementary skills people, and recognize, especially in the case of some academicians who are spinning out new technology. You know, some academicians may be a doctor in a given field, but don't recognize that doesn't translate necessarily to management and financial and marketing skills, and they have to hire to those skills. And I think tied to that is the willingness to share equity with your key employees and key advisors. And I think lastly, there's a paranoia about competition. What I mean by that is some people think there's no competition, and there's always competition, or that their product is so secret they don't even want to discuss or talk about their product out of fear of someone stealing it. And that just doesn't, I don't think that happens in our business.
The kinds of mistakes that entrepreneurs make to preclude them from gaining financing are a couple. Number one, it's really all about a network. An awful lot of entrepreneurs don't network very well. They don't take the time to go out and go beyond the traditional venture capital, angel investor community to really find out and seek out those individuals who truly would invest in their company at probably more agreeable terms than the traditional folks that you'd expect on a day-to-day basis. Another thing that entrepreneurs generally don't do is they don't understand the dynamics of their business as well as you would expect. In other words, an awful lot of entrepreneurs really love the technology and feel that if they build it, someone's going to buy it. One of the questions that, and a series of questions that any investor will ask an entrepreneur is, well, if something goes wrong, what are you going to do if? If this doesn't go right, how are you going to react to that? If the market doesn't grow at such and such a rate, what are you going to do? And quite frankly, what we see are an awful lot of entrepreneurs who have those questions brought before them. All they've thought about is the good stuff that could occur, and don't think about, well, if this happens or that happens, or the dynamic change or the market crashes or the economy shifts, how am I going to grow my business? And quite frankly, how am I going to provide a return on investment to my investors?
Your success as an entrepreneur is predicated on getting a certain amount of money for a certain job and a certain project, and it really doesn't matter where the money comes from, first and foremost. If you have a plethora of opportunities vis-a-vis where you can get the money, then yes, you'd probably want to get smart money, money that can help you in the longer term, but smart money that doesn't show up at closing isn't terribly useful.
I don't think every entrepreneur should be going to a venture capitalist. There are a lot of other sources of funding. There's bootstrap, there are angel investors, there are networks of private investors. Venture capital is really for those entrepreneurs who are attacking very large markets, would need to grow very quickly, for whom first mover advantage is absolutely critical, and for entrepreneurs who are willing, frankly, to give up a large percentage of their equity to someone who's managing money on behalf of even larger institutions.
There's a couple different ways to fund a company, particularly in today's environment. You know, the most popular and easiest, frankly, is to bootstrap a company. If you've got people who are willing to give you money to get a service rendered or a product developed, there's a pretty good indication that more people will pay you over time. Once you've used up that as an alternative, a subsequent way is venture capital or angel capital. First of all, both angels and venture capitalists love to see a company that's already got a revenue stream from bootstrapping.
There are multiple ways to fund a company. There are traditional ways through seed capital, venture capital, angel investors, but there are a multitude of alternative financing available in the marketplace. One that we bring to the marketplace is leveraging what's called a 504B, which allows a company to go to the public markets, the stock exchange, sell stock into the marketplace, thereby taking advantage or deriving revenues into the company from the open markets.
Well, there are about at least a half a dozen ways to get investment funds into a startup company. As simply as going to your friends and family and asking for some money, $10,000, $50,000 or more. And there are pros and cons certainly to that. If you want your family to be very, very much a part of your company, and every time you have a family gathering, if you want them asking questions about your business that day, that's what you'll get with family and friends funding. If you go to angel investors or venture capitalists, then there are several things that you must do. You must put together an executive summary, you must put together a business plan, and you must put together a dynamite presentation pitch for them. You also could get funding from or loans from banks. You can get an SBA loan, or you can go to the government for an SBIR grant, or the government will have some grants for specific technologies that might be of interest to the nation.
Well, the 504 really provides multiple advantages to a small entrepreneurial company. To do a traditional IPO would require engaging in a Wall Street firm, a blue chip Wall Street firm, investment banking firm, which would cost upwards of hundreds of thousands to millions of dollars, and the scrutiny is incredible. And it would also require numerous hours of the management team. And quite frankly, the requirements from a financial perspective on an ongoing basis really preclude an awful lot of small companies from even contemplating going to the public markets. The 504 offers small companies the opportunity to go to the public markets through what's called a mini IPO, and again, gain access to the public markets. We like to refer to it as crawl, walk, run. As a company, if a company were to do a traditional IPO, it would quite frankly require a management team that has experience in dealing with markets on the big board. The reporting requirements are very, very heavy. The expenses are quite onerous, into the hundreds of thousands of dollars a year. The 504 opportunity provides a company with a prospect of going to the public markets, but at far lesser cost, far lesser, a smaller degree of distraction to the management team, but ultimately provides them with similar access to the public markets over a period of time. The 504 offering has been out for several years. The issue is most people really don't know about most alternative financing that's available in the marketplace today. So it is a fairly unique offering. It's an opportunity we found with angels sitting on the sideline, the angels investors sitting on the sideline, and with venture capitalists truly not acting as venture capitalists anymore. They're more mezzanine bankers. We found a tremendous need in the marketplace for entrepreneurs, young companies that have revenue streams to seek financing to help grow their companies. And so the 504, again, provides this unique vehicle whereby these companies have access to the public markets to help grow their companies versus trying to go out to venture capitalists. One of the things to keep in mind between a 504 and going to the traditional VC route is VCs require a tremendous amount of equity in your company just to consider doing business with you. In other words, most VCs will require between 60 and 80% of your company in equity and ownership in your company for access to their capital. With a 504, the dilution to the founders is minimized to a small degree, and which leaves the founders and original shareholders obviously with less dilution and more opportunity for appreciation in the value of their stock and their holdings within the company. The process towards a 504, first of all, you have to have a business plan that's been documented that will support the business, because the business plan in turn is placed within what's called a private placement memorandum. That private placement memorandum is then sold to a group of investors who are willing to go and buy into the company early on before it's gone public. At that point in time, there is a requirement to go through the NASD, which is a regulatory agency to ensure that the company's financials, their business plan, follow muster so that the company can go public. Once the NASD has been engaged, then the company is then listed on what's called the pink sheets, or the bulletin boards. At that point in time, the company can sell stock in the marketplace. Quite frankly, that's the beginning of the process, and then through additional efforts and filling out additional forms with the SEC, the company then moves on to the OTCBB, which is really a much larger market. It is a market that thousands of investors participate in, and thus allowing the company now to have access to a huge investor base. And quite frankly, that's where you see the volume and share price both go up as the company execute. After the OTCBB, the company now has the option and opportunity to grow either to the American Exchange, the Amex, or to NASDAQ, depending on their asset base and other requirements. Well, to engage in a 504 is fairly unique. The 504 itself is only offered in 2 states in the United States to date, Colorado and Texas. Those are the 2 states that support a 504 offering. The way to engage, there are multiple companies. If you go on the internet, type in 504B or Regulation D 504, you'll find a multitude of companies that provide either software or a set of services. We provide a full set of software and services where literally we take a company and handhold it through the entire 504 process, helping them draft their business plan, helping them with all the forms and requirements and communication with the NASD, the regulatory agency that manages the pink sheets or the OTC, and also help manage them towards the OTCBB through submitting all the forms to the SEC as they move up to the bulletin board. So the best way would be just to go on the web, look for different companies that provide a full set of services to leverage this 504 process.
No matter how smart you are, no matter how good looking you are, no matter how great your idea is, there is still an excess of demand with regards to the supply of capital. So it's hard to get. So my strongest possible advice is don't give up.
You're never going to know what it's like. You can watch all the videos, you can read all the books, take all the courses, live vicariously in many, many ways, but until you do it, until you find a management team you're comfortable with and a group of people you like and an idea you really feel passionate about, you're not going to know the feeling of success. So my encouragement is go out and make something happen.
I really hope any of you who are looking for funding can do it right, can do it quickly, and can do it very successfully. Lots of luck to you.
Well, good luck to you. Have a great time. Again, this is probably the most exciting opportunity you'll have in your career. And this is an opportunity to develop a network of investors and individuals that will last a lifetime.
I've heard stories of people visiting 50 and 60 and 70 VCs before they get financing, but they're financed. We are in a tough market now, but persevere and it'll happen. If you have a good product and a good market, it will happen.
I hope you enjoyed this video on how to finance a high-tech startup. If you'd like to find out more or order additional copies of this video, go to www.channelmill.com/video. Thanks and good luck.